Joshua Holt with the Holt Real Estate Team and Keller Williams Realty. And tax day is soon to be upon us. And today I wanted to talk to you about 5 sweet tax deductions that you may not be taking advantage of when selling your home. So you may be wondering if you're taking advantage of all of the tax deductions that are available to you. And in talking to a number of folks, I know there's been a lot of confusion on what changed with the most recent tax law changes in the last couple of years, and are the same deductions still available and whatnot. So I wanted to take a few minutes today just to run through 5 pretty key tax deductions that hopefully you're taking advantage of if you're able to. And if not, now you know, and you'll be prepared for when you're ready to file your taxes. Number 1, the first one that I think most people probably are not aware of is the selling costs, or the cost to actually sell your home. Now, there are some important caveats to this to be aware of. First of all, what are the selling costs? Well, they can be really anything that's directly related to the sale of the home, and that as long as you've lived in that home for at least 2 of the last 5 years. So sorry, unfortunately, this doesn't apply to investment properties. It has to be a home that you did owner-occupy, like I said, at least 2 of the last 5 years to qualify for. These costs can include legal fees, title fees, commissions paid, and perhaps even staging fees to get your home ready to go on the market. So those could be things that you could be taking advantage of. Now, keep in mind, it's not just a straight deduction. How it works is, let's say you sell your home for $250,000 and you have, we'll just say $20,000 in selling cost. You would deduct that from the $250,000, and then that net would be the amount that you would claim as the selling price for your taxes, and that would impact your capital gains, which we'll talk about here in a moment. 2, and could be a really good one, is any home improvement costs and repairs. Now, here's the big thing on this. Timing is really of the essence with home improvement and repairs. And by that I mean it needs to be costs that you incurred within 90 days of closing. So if you had certain repairs that needed to be done to satisfy an inspection contingency, or maybe just before you put it on the market and you got a quick sale and quicker closing within that 90-day window, you did some things like new paint, some updates, upgrades, so forth, those costs could potentially be deducted as a tax deduction. So really, once again, it all depends on the timing, but if that works for you and you fit within the timing, you could score yourself another really cool deduction in terms of home improvements and repairs. Probably the biggest one that's been the most confusing for people has been property taxes. There was a change in how much you could deduct in property taxes on your income taxes, and that now is capped at $10,000. So if you've been dutifully paying your taxes as you should along the lines up to the point of when you sold your home, you should be able to deduct what the amount you paid in property taxes up to $10,000. So it doesn't mean it's an automatic $10,000. It's up to. So of course, if your taxes are less than $10,000, you would just deduct the amount for the time that you did live in the home. Number 4 would be mortgage interest. So with the as with property taxes, you could deduct the interest on your mortgage for the portion of the year that you own the home. So just remember, though, that under the 2018 tax law changes, they put a cap on that at $750,000 of mortgage debt, unless, of course, you obtain that mortgage prior to December 15th, 2017, then it's still up to $1 million. Now, note that with the mortgage interest and the property taxes, so both of those are itemized deductions, so that does mean that in order for that to work in your favor, all of your itemized deductions need to be greater than the new standard deduction. So definitely keep that in mind when you're preparing your taxes. And finally, number 5 would be capital gains tax for sellers. This is something that I hear quite often when I'm meeting with folks talking about selling, is they're all like, oh, I don't want to pay too much in capital gains, or I want to limit how much I pay in capital gains. Well, capital gains rule, it isn't technically a deduction. It's more of an exclusion, but I think you're still going to like how this works out. So as a reminder, capital gains, what are they? They're the profits from selling your home. Whatever cash is left after paying off all of those expenses, paying off your mortgage debt, And yes, the profits are taxed as income, so keep that in mind. But here's the good news. You can exclude up to $250,000 of the capital gains from the sale if you're single and $500,000 if you're married. So in our market, that actually covers quite a few home sellers when you look at how much you can exclude. And the only real big catch here is that, once again, you must have lived in your home at least 2 of the past 5 years to qualify for that. So my advice, of course, would be is if you want further clarification on these 5 sweet tax deductions, I recommend you consult with your tax advisor or accountant. Of course, I'm a realtor, not an accountant. However, I feel it's important to share with you these great tips, and I hope that you have found this information to be beneficial as tax day is approaching here soon. So once again, this is Joshua Holt with the Holt Real Estate Team and Keller Williams Realty. And as always, if you have any questions on the local real estate market, or if you have any suggestions for topics that we could cover in a future video, please give me a call at 608-345-6594, or you can always email me at jdholt@kw.com. I thank you for taking the time to watch our video today, and I hope you have a great rest of your day. Take care.